Have you ever wondered in this digital age why our money isn't digital too? Well, it is. Welcome to the world of cryptocurrency. Cryptocurrency, a term that buzzes around our world today more than just a buzzword, is a revolutionizing concept that's reshaping the way we perceive and use money. It's a digital or virtual form of currency that uses cryptography for security, making it extremely difficult to counterfeit. This world of digital currency is vast and intriguing. It's a world built on the principles of decentralization, transparency, and security. A world where the power of controlling and managing money is not in the hands of a select few, but distributed among many. Cryptocurrency is more than just Bitcoin, the first and most popular one. It's a wide-ranging ecosystem with thousands of different digital currencies, each with its unique features and uses. From Ether to Ripple, Litecoin to Cardano, there's a lot to explore and understand in this realm of digital finance. Over the next quarter of an hour, we're going to take a deep dive into this digital world. We'll explore the birth of cryptocurrency, understanding why and how it came into existence. We'll delve into the unique features that set cryptocurrency apart from traditional forms of money. Then we'll unravel the mystery behind blockchain, the technology that underpins cryptocurrency. We'll learn about how cryptocurrency transactions work and how they are recorded and verified on the blockchain. We'll also discuss the value of cryptocurrency, what gives these digital assets their value, and why do their prices fluctuate so much. And finally, we'll wrap things up with a look at the potential future of cryptocurrency and its impact on our everyday lives. Cryptocurrency is not just a trend or a fad, it's a significant shift in our financial landscape, a shift towards a more inclusive and transparent system. So buckle up as we delve into the intriguing world of digital currencies. Cryptocurrency wasn't born overnight. It's a product of years of innovation and technological advancement. The genesis of this intriguing and somewhat mysterious world can be traced back to 2009, when the first cryptocurrency, Bitcoin, was created. An individual, or perhaps a group known only by the pseudonym Satoshi Nakamoto, was the mastermind behind Bitcoin. Nakamoto's objective was not just to create a new form of money, it was to challenge the traditional financial system by introducing a decentralized digital currency free from government control and banking systems. This was a currency that could be transferred directly from person to person across the globe without the need for intermediaries, a currency that promised privacy, security, and autonomy. And with that, the first digital coin, Bitcoin, made its entry into the world. Now you may be wondering what sets cryptocurrency apart from traditional money. Well, there are several key characteristics that make it unique, and today we're going to delve into them. First off, let's look at decentralization. Unlike traditional currencies, which are regulated by central banks and governments, cryptocurrencies operate on a decentralized platform. There's no central authority here. Instead, transactions and issuance of new coins are overseen by a network of computers, also known as nodes. This means that no single entity has control over the currency, and that's a big deal. It gives users more freedom and control over their money. Next up is encryption. Cryptocurrencies use cryptographic techniques to secure transactions and control the creation of new coins. Each transaction is encrypted into a complex mathematical problem that the nodes must solve in order to process the transaction. This not only ensures security but also provides proof of the transaction's validity. Then there's the blockchain technology, the backbone of all cryptocurrencies. A blockchain is essentially a public ledger of all transactions ever made in a particular cryptocurrency. It's constantly growing as completed blocks, which contain the most recent transactions, are added to it in a chronological order. This transparency helps foster trust and security among users. Lastly, cryptocurrencies do not have a physical form. They exist only in the network. You can't hold a Bitcoin or an Ether in your hand. Instead, they are stored in digital wallets, which can be accessed through computers or smartphones. This lack of physicality also makes cryptocurrencies incredibly portable. You can carry around millions worth of Bitcoin in a simple flash drive. These unique properties are what make cryptocurrency a game changer in the financial world. Cryptocurrencies are not just a new form of money. They represent a completely new way of thinking about and transacting value. They offer a level of freedom, security, and accessibility that traditional currencies simply can't match. And that, dear listeners, is why cryptocurrencies are not just unique, but revolutionary. At the heart of cryptocurrency lies a revolutionary technology, blockchain. Blockchain is a network of computers, known as nodes, that work together to store and verify records of transactions. Think of it as a digital ledger that is distributed across multiple computers. Every transaction that happens on this network is recorded in a block, and these blocks are then linked to each other in a chain-like sequence, hence the name blockchain. Now, how does this lead to security and transparency? Well, imagine you're sending a cryptocurrency, say Bitcoin, to a friend. This transaction is broadcasted to the entire network, and every node on the blockchain verifies it before it's added to the block. If someone tries to manipulate a transaction, the network would reject it because it doesn't match with the records on the other nodes. This makes fraud and double spending nearly impossible. Moreover, every transaction is transparent and can be traced back to its origin. Yet the identities of the people involved are kept private, known only by their digital addresses. This balance between transparency and privacy is a key feature of blockchain technology. But what does this have to do with cryptocurrencies? Well, cryptocurrencies are essentially pieces of code or tokens that are created and managed on a blockchain. When you own a Bitcoin, for example, you own a token that exists on the Bitcoin blockchain. The blockchain records who owns what and ensures that tokens can't be copied or forged. So blockchain technology enables cryptocurrencies to function in a decentralized, secure, and transparent way. Without blockchain, there would be no Bitcoin, no Ethereum, no Litecoin, or any of the other thousands of cryptocurrencies that exist today. This technology is not only reshaping the world of finance, but it's also paving the way for a new era of decentralized applications, from voting systems to supply chain tracking, that could revolutionize various sectors of our society. Blockchain technology is the backbone that keeps the digital currency world running smoothly. So, how does a cryptocurrency transaction take place without a central authority like a bank, you might be wondering? Well, let's dive into the intricate process and see how it all unfolds. At the heart of every cryptocurrency transaction, we find two essential components: the public key and the private key. The public key is your cryptocurrency address, a unique identifier that others can use to send you funds. On the other hand, the private key is like your secret password. It's used to sign transactions, confirming that you are the rightful owner of the funds being sent. Imagine you're sending a friend some cryptocurrency. Your transaction is bundled with others into a block. This block doesn't automatically become part of the blockchain, the decentralized ledger where all transactions are recorded. It has to earn its place, and that's where the process of mining comes in. Mining is essentially the act of validating transactions. Miners, who are individuals or groups with powerful computer systems, compete to solve complex mathematical problems. The first miner to solve the problem gets to add the new block of transactions to the blockchain. This process ensures that transactions can't be tampered with, maintaining the integrity of the entire system. But let's rewind a bit. Before your transaction even makes it into a block, it has to be verified. Miners check that you have enough cryptocurrency in your wallet to send. They do this by looking at your transaction history on the blockchain. If everything checks out, your transaction is added to the block. Now back to the miners. Once the problem is solved, the winning miner adds the block to the blockchain. But they don't do this for free. They receive a reward, a certain amount of cryptocurrency for their hard work. This is how new cryptocurrency is created and circulated. But what happens if two miners solve the problem at the same time? Well, the network will accept the block that becomes the longest through the addition of subsequent blocks. The transactions in the discarded block are returned to the pool to be included in the next block. This is why it's recommended to wait for several confirmations before considering a transaction final. Every single transaction is transparent and can be traced back through the blockchain. This transparency is a powerful tool against fraud and corruption. It's like having a bank statement that's public for everyone to see, yet completely anonymous, as people are identified by their public keys, not their real names. To sum it up, a cryptocurrency transaction goes through several stages. It starts with the signing of the transaction using private and public keys, followed by verification and mining, and finally, the addition of the transaction to the blockchain. This decentralized process eliminates the need for a central authority such as a bank to oversee transactions. It's a complex process, but it ensures every transaction is secure and transparent. And that's the beauty of cryptocurrency transactions. The complexity is its strength, ensuring the integrity and security of a financial world without borders. Ever wondered why the value of cryptocurrency fluctuates so much? It's a question that has puzzled many, but the answer lies in a combination of factors, much like traditional currencies. Let's dive in. Firstly, we need to understand that the value of a cryptocurrency like Bitcoin, Ethereum, or Ripple is not backed by a physical commodity like gold or silver. Instead, the value is determined by the market, that is, what people are willing to pay for it. This is where the concept of supply and demand comes into play. When more people want to buy a cryptocurrency than sell it, the price goes up. And when more people want to sell than buy, the price goes down. Secondly, the utility of a cryptocurrency can greatly influence its value. Utility refers to the usefulness and versatility of the cryptocurrency. For example, Ethereum isn't just a currency, it's also a platform that enables developers to build and deploy smart contracts and decentralized applications. This utility drives demand and subsequently, the value of Ethereum. Next, market sentiment plays a crucial role. The cryptocurrency market is highly susceptible to news and public opinion. Positive news, like a country legalizing cryptocurrency or a major company accepting Bitcoin as payment, can send prices soaring. Conversely, negative news, like regulatory crackdowns or security breaches, can cause prices to plummet. Finally, it's worth noting that the value of a cryptocurrency can also be influenced by the actions of whales, individuals or entities that hold a large amount of a particular cryptocurrency. Their buying and selling activities can cause significant price fluctuations. But remember, with the high potential for returns comes a high level of risk. Cryptocurrency values can be extremely volatile, and investing in them should be done with caution. So, there you have it. The value of cryptocurrency is a complex interplay of various factors, much like traditional currencies. The world of cryptocurrency is a fascinating one, filled with potential and volatility in equal measure. Cryptocurrency is more than just digital money, it's a new way of thinking about financial transactions. This is the thought we've been exploring throughout our journey today. We've traversed the birth, uniqueness, and value of cryptocurrency, delved into the intricate workings of blockchain, and decoded how cryptocurrency transactions occur. It's a complex, exciting world, and it's reshaping our financial landscape. Let's take a moment to revisit the key points we've touched upon. Cryptocurrency, as we've come to understand, is a digital or virtual form of currency that relies on encryption for security. It's a decentralized system, free from the control of any central authority. This decentralization is possible thanks to blockchain technology, a public ledger containing all transaction data from anyone who uses Bitcoin or other cryptocurrencies. We've also discussed how cryptocurrency transactions work. These transactions are secured by cryptography and recorded on the blockchain, providing a level of transparency and security traditional financial systems often struggle to match. The value of cryptocurrency, as we've seen, is derived from various factors, including supply and demand, market sentiment, and technological advancements. But let's not forget, as with anything else, cryptocurrency comes with its own set of challenges and risks. The volatility of the crypto market can lead to drastic price changes in short periods. Plus, the lack of regulations and potential for misuse are areas of concern that need addressing. However, it's important to remember that these challenges are not insurmountable. They present opportunities for growth and improvement. The potential future of cryptocurrency is vast. Imagine a world where cross-border transactions can be completed in seconds, not days. A world where financial systems become more inclusive, opening doors for those who have been left out by traditional banking. A world where the control of money is not in the hands of a few, but dispersed among many. This is the potential world that cryptocurrency offers. However, this future is not guaranteed. It requires understanding, acceptance, and the adoption of this new form of currency by the masses. It requires governments to develop regulations that protect consumers without stifling innovation. It requires technological advancements to address issues of scalability and energy consumption. In conclusion, cryptocurrency is not just a new form of money. It's a revolutionary technology that has the potential to redefine our financial systems. It's a tool that can empower the masses, democratize money, and create a more equitable world. It's a complex, evolving field that poses both challenges and opportunities. So, as we stand at the cusp of this digital revolution, it's essential to continue learning, to stay curious, and to keep an open mind. Because, as we continue to evolve digitally, the role of cryptocurrency in our financial systems may grow. Understanding it today might just give you an edge tomorrow.